From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to another episode of the Macrocast. I'm your host, Ylan Mui, and Managing Director at Penta, and I'm joined, as always, by Brendan Walsh and John Fagan from Markets Policy Partners. Hey, guys.
Good morning.
Good morning. Well, today's episode is all about jobs. The Labor Department has released its monthly employment report, and it seemed to be pretty much in line with what markets were expecting. The economy added 236,000 jobs in March, a slowdown from the start of the year and really since the start of the post-pandemic cycle, but a decent amount still. The unemployment rate edged down to 3.5% as people came back into the labor force. So, John and Brendan, what do you make of these numbers? Good, bad, or neutral?
Yeah, right down the fairway. I guess we've all got golf on the brain with the Masters on. So this really was, a straight shot off the tee, as you said, Ylan, right smack into consensus. And that's a good thing, boy, because, with markets closed for a lot of the markets closed for the holiday in the U.S., Good Friday holiday in other places overseas, that liquidity was always going to be low and you wouldn't want a big volatility inducing number. So this is a pleasantly expected result ahead of the long weekend. And markets are showing that very placid reaction, positive reaction, the same kind of reaction we got to the last non-farm payroll number, which showed this kind of Goldilocks twinge to it, I guess. When you looked at it, it had this, the relatively tame average hourly earnings and so forth. So we're seeing, a gentle upswing in equity futures and calm treasury markets.
There actually are some. It's not troubling, but it's a kind of a tale of two cities. The 180,000 of the jobs were created by government, healthcare and education, and leisure and hospitality. Those were the three sectors that were heavily affected by COVID, and they're kind of playing catch up. So that's a very good sign that people are finally being hired in those. But when you look at goods producing, they lost 7,000 jobs. Retail trade lost 15,000 jobs. And construction was down 9,000. And also kind of a little troubling, because this tends to be a canary in the coal line, temporary help services lost 11,000 jobs. That's always a leading indicator. So what you're kind of seeing is part of the economy that was heavily wiped out by COVID playing catch up. But the other parts of the core parts of the economy are definitely slowing, which is the goal of the Fed. So I worry maybe that the Fed could take this as a bit too strong of a report and over tightened, where there actually are some signs of weakness within this report.
And just as an aside, yields are turning up a little bit in the treasury markets, and so we are seeing some upside pressure. And I think that really speaks to what Brendan has pointed out, that this, we saw a lot of this week circle around relatively weaker jobs data that came out in advance of this non-farm payrolls number, that it really settled down treasury yields over the past week or so. And most of that gain is being kind of given back this morning. And, it's still basically a coin flip in terms of the Fed outlook for the May decision, whether they're going to go 25 basis points or sit tight.
Yeah, I think that some of the details of the report and seeing which sectors gained and lost jobs is really interesting. Brendan, I think that, it seems to be a reflection of where we are, even when you look at the inflation numbers in terms of inflation coming down for goods, and inflation still pretty hot for services. I thought you mentioned the construction sector in particular losing jobs. That was interesting just because of all of the changes that we've seen in the housing market, rates coming down, maybe prices starting to ease in housing, but still pretty strong. What do you make of the fact that we're seeing construction finally starting to weaken?
I think it's the higher rates is hurting the housing sector, and you just can't afford, because also the prices haven't dropped yet, so we're just not seeing many sales. So if you're a builder, you got to take out a loan now that it's twice as expensive as it used to be. And also you don't know how long you're going to have to be sitting on that before it can sell. So I think a lot of the housing construction has just stopped building houses, which is actually very dangerous because we do have still have a shortage of housing in most of the places. So what has to happen is prices need to start to fall. We're seeing it slowly happen. We could really see a huge drop come this summer where people just can't afford to keep paying those rates, and that will hugely show up in the inflation numbers because housing is such a large component of it. It's already going to start seeping into the CPI and PCE. March will probably be the first one where we see negative growth in the housing component, which that'll be a huge drag on the overall inflation numbers. The other good sign for inflation is the participation rate keeps going up. We're back to 62.6%. So that whole idea, the lost people from COVID, they are coming back. The most fascinating data point I saw from this is the Black employment to population ratio is now higher than the white employment to population ratio, and it's both the African American rose, but also the white population to employment has plummeted. It used to be about 65%. Now it's at 60.
Yeah, especially as you see the construction numbers start to weaken. I wonder what that's going to mean for white employment figures going forward. But I thought it was interesting when you brought up the Black employment numbers. The Black unemployment rate fell from, I think, 5.7 to 5%, which may be a record.
It's a record. It's never been this low.
Yeah. So I think that's, I think that creates, once again, another conundrum for the Fed, because do you need to have this hot of a labor market? Do you need to have this tight of a labor market to start to chip away at some of the longstanding inequalities that we've had, in society for a very long time? If the Fed is going to start to tighten, if the goal is to slow down the labor market, does that by proxy also mean that some of these benefits that we've seen, particularly for underserved communities, start to go away?
Oh, it's a very important point. The Fed has a dual mandate, and they're ignoring half of their mandate. They're actually doing the exact opposite. They're trying to destroy the employment figures, which a lot of people are having a very hard time dealing with that.
Yeah, you also mentioned temporary employment as a potentially leading indicator. Yep. What did we see happen here? And how does that normally show what's going to happen in the future? How does that normally a predictor of future growth or future cuts?
Yeah, so a year ago, we had 28,000 temp jobs. In January of 2023, we had 17,000. And then last month, we had about 4,000. Now, negative 11,000. And that's always just a very good sign of kind of startups. If you're starting a new company, you don't hire everybody. You hire temps. And then if they're good, you take them on full time. So if you're not hiring temps, that just is a very clear sign that economic activity is slowing. And I would expect that to slow even more, especially, our mini banking crisis. I think the crisis part is over, but banks are going to be lending less, and you're going to see less startups. You're actually already starting to see a tick up in small business bankruptcy filings.
Interesting. John, you also mentioned that the sort of quieter jobs number that we saw today was reflective of some of the other economic data that we got earlier in the week. What did that portend?
Yeah, earlier in the week, I'll let Brendan get into more of the details of it, but we had the job openings and the JOLTS, the job openings and levers, right?
Job openings and labor turnover. Yeah.
Yes, there you go. And we saw the ADP number that the payroll giants estimate of non-farm payrolls was a little on the light side, and these kind of kindled this concern about growth that had been overshadowed by the bank. With the market really focused on the acute phase of the banking issues. Once that had passed, now markets are free to cast their view a little bit further out, and what they're seeing is probably this, as Brendan alluded to, this tightening of monetary conditions that flows from the problems in the banks hitting the economy. And if you had, if you were sort of 50-50 on recession later this year, well, that's going to just tip the balance in favor of a contraction potentially. And so we've seen a little bit on that kind of price action. We've seen the yield curve, inverting more deeply, the Treasury yield curve, which is a classic harbinger of coming recession. And as we've alluded to multiple times, that great divergence between the Fed's rate outlook and where Fed fund futures are. Fed fund futures are pricing in between 50 and 75 basis points of rate cuts before year end. That would assume a very dire economic outcome. So the message from the bond market is very glum. The message from equity markets is, a little bit tentative and nervous, and the dollar doesn't seem to know which way to go.
Yeah, the dollar is really just stuck there. And even we can get into it later, but, OPEC, cut 1 million barrels, and we had a 5% jump, but now it's petered out. It's hard for any asset that trades off of global growth to get too out of control right now. The China is growing below what they even thought, and Europe is also slowing at a similar pace to the United States.
Yeah, we're going to talk about oil prices in just a little bit, but just sticking with the jobs report for now. If we keep getting numbers like this, does that mean the Fed still needs to hike because the market is still too hot? It's still high enough to drive inflation? Or if we keep getting numbers like this, does this mean the Fed can sort of stay the course? Is this enough?
I think the futures markets are basically giving the Fed kind of an amber light, so to speak. It's basically. Yeah. If they hike 25 basis points in May, it's not going to be a big surprise. If they hold, it's not going to be a big surprise either. If they were to, hike rates, it's probably going to be accompanied by relatively more dovish communications alongside that, focusing on, the question about future growth and that sort of thing. If they hold, they would probably balance that out with slightly more hawkish intonations around the decision, and emphasize that they can still go higher if they need to, and so forth. So May is sort of, I wouldn't call it a layup for the Fed. Nothing is easy in this environment, but the market seems to be, letting the Fed make the call. Now, a 50 basis point would be a big shock, but we don't think that's on the table at all.
Well, after the ISM number earlier this week, which was very, very weak, much below expectations, the Fed funds future for the first time put the odds of a 25 basis point hike at the next meeting below 50%. So it's only slightly below, but that hasn't happened in a while.
Do we need to see the labor market cool even further over the next few months in order for us to see a meaningful drop in inflation?
Not inflation, but I do think for the Fed to stop hiking. The Fed always hikes too much, and these guys seem intent to do it. Bullard is, saying the banking crisis is over, we need to keep hiking. They're going to make the mistake because they're looking at very backward indicators, and the labor market is an incredibly backward-looking indicator. This data today is strong enough to, if in their metrics, to justify. But if you actually take a step outside and look what's really going on, I think that the economy is really slowing. And I also think that they're massively underestimating how much the lack of loan growth that's going to happen is going to slow the U.S. economy.
So the Fed is looking backward, but we are going to continue to look forward. We're going to take a short break, and when we come back, we will take a closer look at oil prices and what's going to be happening in the week ahead. Stay tuned.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at PentaGRP.
And we're back with the Macrocast, talking, of course, with Brendan Walsh and John Fagan of Markets Policy Partners. So this is spring break season, and many of you may be listening to this podcast as you are driving to the beach. Gas prices, of course, are top of mind during the season. And as we head into the summer, they've come down a lot since they peaked at about $5 a gallon last year, but they've started to move up again in the first few months of this year. And now, of course, Saudi Arabia and other OPEC countries have announced a surprise cut in production, slashing more than 1 million barrels a day starting in May, which means that prices in the future at the pump and for oil markets are going to rise. Not necessarily a good sign for inflation or for the White House or for your wallet. So Brendan and John, help us understand what's happening here. First of all, just break down, why did OPEC take this move?
Yeah, so it was very unexpected. It caught a market's offside, and so resulted in a pretty swift upswing in prices, a really shock upswing in prices, almost $10 a barrel, like right out of the gate. Once they started trading, they announced it over last weekend, and essentially this was in response to having oil prices kind of languishing around 16-month lows, right? I mean, these were not, by historical standards, rock bottom oil prices. We're talking about, like, for Brent crude, low 80s, high 70s, and that's a very comfortable kind of price for a lot of producers, particularly in the Middle East and OPEC. But the question really was about the future demand. We've seen OPEC under the current Saudi energy ministry leadership really being proactive and leaning into the markets and trying to get ahead of developments. And they've been vindicated. They cut production last year, which wasn't appreciated by the Biden administration, but it certainly didn't send prices skyrocketing. It sort of was more of a controlled descent. And to the extent that they're looking out and not liking what they see in terms of the demand picture, well, you can perhaps justify it in that way. From the Biden administration, this is not helpful. They criticized it, as they would, and it's sort of as part of the mosaic that's forming of geostrategic alignment that's adverse to the United States in the Middle East, and with sort of Russia, China, and so forth. It's another sort of troubling aspect, showing some, that U.S. power is being countered and U.S. influence is being countered in certain areas. But on the other side, the Biden administration had said that they were going to be filling up the strategic petroleum reserve under $80 a barrel, and there seemed like this demand, this demand kind of had put a floor under prices, but it appeared that they weren't going to be stepping into the market. And so I think that's when OPEC sort of took their cue.
John, when do we find out whether they bought?
That's a good question. I don't know. I don't know when they the exact publications are, but the expectation is that the Saudis are looking out at the demand picture, and they're not sure they like what they see, and that's another relatively grim harbinger of the coming quarters.
Yeah, for context, just what matters to us is the gas prices. So a week ago, the average price in America was $3.50. So it went up 8 cents this week, which is only 2%, but it'll probably keep climbing. But more importantly, a year ago, the average was $4.15. So we are down considerably from where we were in 2022.
Yeah, and it bears mentioning that the initial shock upside in oil prices that followed the announcement really came off quite a lot. And oil prices are really only up $5 since that announcement, which isn't nothing, but is far from shooting the moon.
Yeah, it's about 5%.
There's if you have a more bullish outlook on the global economy, that's causing some big investment banks and so forth to mark up a couple of quarters out, like a $90 to $100 barrel as their target prices, as the market tightens up. These cuts come online in May, for instance. So that's certainly a possibility, and one to watch, which would be obviously a headwind on growth if oil prices are chasing up along with a global recovery.
Though the wild card on future oil prices is our shale production has been flat. That whole industry got consolidated. So now it's kind of adults in charge, where previously, as soon as you had a chance, people were pumping. So the United States production has really been flat over the last couple of years. So if we do see an uptick in global growth, you're going to see the United States pump a lot more because we have the capacity to do it.
Yeah, I think one of the questions I had just out of the conversation that you all just had as well is this a reasonable move by Saudi? Because they are estimating, or they are expecting to see demand to become weaker. If we are expecting a recession here in the US, if Chinese demand is not reaching the heights that folks had expected coming out of their COVID lockdowns, then maybe this move makes sense, even if it was something that was a surprise to the markets.
Yeah, I think it's certainly that's certainly a valid justification. And as I mentioned before, that the previous time last fall when they cut prices, I mean, looking back on it, they seem to be relatively well vindicated in the way that the market has behaved, and they did encounter a soft patch in growth. So if flash forward, a couple of quarters and we're at $100 a barrel, and the global economy isn't in great shape, and oil prices are that high, that's not a particularly positive formulation. That's stagflationary challenge and makes the Fed's life that much harder.
John, you also mentioned sort of shifting geopolitical alliances there, perhaps alluded to it. There's been some talk about whether Saudi is shifting closer to China, and some discussion around whether it might consider pricing sales of oil to China in yuan instead of in dollars. Seems like that would be a major development in terms of, whether the dollar could remain the world's reserve currency. It seems like it would have major political implications in terms of the closeness of the relationship between Saudi Arabia and China. Do you see any risk of de-dollarization here?
Well, I think that there's, the sort of scary stories and scary headlines about de-dollarization. These crop up ever so often, right? And, this is not the first time we've heard this. This is something of a novel formulation, obviously, and the geostrategic backdrop is potentially more worrisome than it has been in previous episodes. But at the end of the day, the dollar has an enormous, first of all, the dollar has an enormous lead, right? And it has it just things that you want to buy and the debt that you want to service is in dollars, right? And that's for the most part. And that's the problem with the renminbi. If you sell oil for renminbi, what do you do with that renminbi? You want to get rid of it because there's not that much you can buy with it. And the Chinese government is very tightly controlling the renminbi. They don't let it be broadly convertible outside of China. And so,
it's also pegged. So you can't have reserve currency that isn't free floating. So if China decided they wanted to do it and they let it float, where would the yuan be trading?
Yeah, well, that's the thing. They can't possibly, let go of the controls that they have over the currency. They don't want to, lose control of interest rates and all of the other things that come along with truly internationalizing your country. If you want to create a relatively kind of closed loop system where you have, a group of like-minded, countries that come together and trade with the renminbi, and it circulates properly, well, maybe you can establish something like that. But I think it's, when it comes to reserve currency status, the renminbi is far from ready for prime time. And from the perspective of the Treasury, where I used to work, the view inside, there's a lot, the Treasury Secretary comments on the dollar, right? And so as a Treasury employee, it's not something you want to go shooting your mouth off about. But inside the halls of the Treasury, there are some vigorous debates and discussion about the dollar that, the public will not ever be privy to. And, the sort of character of a lot of these discussions when it comes to things like, the concept of the dollar as the global reserve currency, I can tell you that like the basic philosophy that animated the discussions under both what I served under the Obama administration and the Trump administration. And uniformly, it was a sense of if we keep our house in order as a country and we make economic policy such that our markets are vibrant and deep, and our companies are strong, and our economy is the envy of the world and so forth, then the dollar's reserve currency status will take care of itself. It's a result of the good work that we do to keep the country and the country's economy and society strong, and the dollar's reserve currency status will take care of itself if we take care of those fundamentals. And I think that's a very healthy posture to adopt.
So oil prices and obviously the jobs report, the big news on the economic front. But of course, there was also big news on the political front this week as well, with former President Trump formally indicted on more than 30 counts of business fraud. Obviously, a historic moment in terms of politics, first president ever to be charged with a crime. But is it something that the markets really responded to or will respond to in the future as this investigation and as this trial goes on?
Yeah, it's pretty hard to see if there were, even a flicker of any reaction in financial markets to this event. newsworthy doesn't always move markets, and I think this is probably one of those cases. Obviously, markets struggle to price in political outcomes. Remember Brexit and some of these other surprise votes tend to catch markets off guard, and they're inherently unpredictable, and markets get offside and so forth. So politics tends to be left until there's a really near term election day or something that is close on the calendar that you can begin to trade within the investable future of just a few weeks on some of these trades. So for instance, like before the election in 2020, you could see sort of the Biden basket, right? You'd see like clean energy stocks and the ETF for, infrastructure going up. And after the two special election Senate wins in Georgia, you saw infrastructure stocks jump. And so you can see these patterns of political trading, but they don't tend to be, all that far ahead of particular political events. So I think this one pretty much passed unnoticed by markets, but politics can certainly move it down the road as we get closer to election day.
I think the more important political event from this week was Speaker McCarthy going on Bloomberg and warning that we're probably going to default on our debt because he's not able to talk to Biden. So that is one that the market is definitely not pricing in, and it's one of those things. It's a black swan event. So I mean, you can't really assume that it's going to happen because it usually doesn't. But we do think this one is at a minimum going to be a lot closer than the previous episodes under Obama.
They have time, right? They have so much time. They have time until they don't have any time, which is the problem. Which is the problem with Congress.
Yeah.
Well, great, guys. Thank you so much. But let's just take a few minutes to look ahead to next week. Brendan, what's on your radar screen?
The inflation numbers. So CPI is coming in next week. That'll be the big one for next week. Pretty much everyone's on vacation too, right?
Well, the IMF World Bank meetings are also happening.
Oh, you're right. Yes. So this is going to be definitely a big one. There's a lot going on. The IMF just put out their forecast, and they said that the growth prospects is the worst it's been since 1990. So there'll be a huge amount of discussion on that front. And then it looks like also the former CEO of MasterCard, Ajay Bagda, is going to be approved to run the World Bank. So I think he's a very impressive human being, and I think that was a great choice. And I think he can do a lot of really interesting, innovative things here at the World Bank.
Great. Thank you guys so much for joining us today. And thank you to our listeners for tuning into the Macrocast. I'm Ylan Mui with Penta. Thank you to John and Brendan from Markets Policy Partners for joining me. Remember to like and subscribe wherever you listen to your podcast. Have a great weekend, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.